Hey everyone, my name is Hunter Satterfield. I am one of the partners here at Kane Waters, as well as the Chief Investment Officer. As always today, I am joined by my fellow partner and the head of the CWA Investment Committee, Brian Bortz. And then I'm also joined by Brad Sanders, the Managing Director of Tectonic Advisors. Today, we're bringing you our September market update. For the month of September, the S&P 500 was up 2.1%. Global stocks right there as well, up 2.3%. And then domestic bonds and global bonds both up 1.3% and 1.7% respectively. So, gentlemen, before I come to you, obviously this is probably our most important recording that we've done likely in the last 4 or 5 years. And that is because just 2 weeks ago, we had our first Fed cut, a significant one. It ended up at 50 basis points, which was certainly a surprise. And we're going to come to you, Brad, to talk through some of that. It is the first 50 basis point cut outside of the COVID cuts that were necessary sort of on an emergency basis since the global financial crisis in 2008. So, folks, this is a pretty significant cut overall. We did have one dissent by a Fed governor, Michelle Bowman, on that cut, who felt like it was more important to be at a 25 basis point cut. And that is the first dissent since 2005. So certainly a lot of things at play. And Brad, I want to come to you first, sort of on that cut. And I think that when you see a 50 basis point cut, or when we hear that, that typically is a sign that there is a looming recession, that there is some fracturing in the broader economy. But then when we go in and we look at consumer data and employment numbers, things look broadly healthy and steady. Certainly not, world beating, but pretty good overall. So I want to come over to you to talk a little bit about maybe why the Fed went with 50 basis points, what that's telling us, and kind of what we're thinking about when analyzing that.
Yeah, I think in short, what that tells you is that that's sort of tacit acknowledgement by the Fed that they probably should have cut a quarter in July. And that's why we got 50 now. I think we've even talked on this video several times that we thought when they started cutting, it would just be a quarter at a time and read the tea leaves, see how inflation and employment was looking, and then kind of ease rates down. And we got that first 50, which was a little bit of a shock because I think they were reluctant in July. And then you see some of the employment data and things like that, which is still good, but it is weakening. And so they were like, we need to basically do those 2 cuts now, let things breathe, and then revisit in November and December. The Fed's worried about several things here. I know their explicit mandate is, employment, low inflation, controlling the rate of interest. But there's also a fear of getting too far behind the curve, where you're not cutting quickly enough to keep up with the economy. And so I think that's why they did this. And it was a little bit of a shock is, hey, we should have probably cut then. Let's go ahead and do it now while things are still good and kind of catch up to where we should be. Interestingly, the 10-year Treasury yield's a little bit higher than it was when they cut. We're at about 3.8, 3.83. We were around 3.6 when they cut, so roughly. So the curve's steepening out. But I think as we move forward, what we're going to see is, barring some shocks from oil or anything like that, or geopolitical tensions, you're probably going to see another quarter in November, another quarter in December, and they've kind of given guidance for another full percentage point of cuts next year, which would get us down to about 3 to 3.5 on the Fed funds rate. That seems about right. The pace of which we're going to get there is going to be economically dependent. We could get there a lot quicker if something were to break, or tensions escalate overseas, and then that kind of speeds up some slowness in our own economy.
Yeah, that's great. And Brian, I want to come over to you and sort of talk, maybe you could talk through a little bit about, sort of based on, the Fed cut, what have we seen more broadly in the markets as a result of that? What are the types of things that we are looking at from the investment committee side on, the impacts on the broader market due to these cuts?
Yeah, thanks, Hunter. What's going on right now with the broader market is that for the first time since the fourth quarter of 22, which was the end of our last recession, the broad market is actually performing better than the Magnificent Seven. And that hasn't happened for quite a while. So we're starting to see a breadth, a widening of performance, and not just the market being dependent on 7 tech companies. Back in early 2016, the Mag 7 made up about 10% of the S&P. And now it makes up 32%, but that's down from about 35%. So we're starting to see that the broader market is gaining a little bit more strength. That's a very positive sign for the economy. I've talked to a lot of clients about the fact that the last recession that we had in 22, if you go back over my entire lifetime of 50 some odd years, we've had a recession almost every 7 years. So we're kind of not technically due for another one for a while if that trend continued. And, depending on how this election goes, I think the market would view a Trump election as positive for the market. I don't think that a Kamala Harris election would be negative for the market necessarily. But then we would look at, okay, policy, who's going to win the House, who's going to win the Senate. The House is really kind of a 50-50, who knows? The Senate right now looks like it's probably leaning towards the Republican side, but ultimately, no matter who wins, it's probably going to be some divisiveness in the House and Senate. So this next month to 6 weeks is going to be a really interesting time for all of us to pay attention to what goes on, not only in our democracy, but also what goes on in our economy, because I think both of those are going to be related.
That's right. Yeah. And thank you, gentlemen, for both of the comments on that. And folks, obviously, as Brian already referenced, we've got just over 30 days ahead of the election. And as we've talked about on this recording and on our podcasts and in our material throughout the year, largely, response from markets is not significant when it comes to elections. And we've seen that thus far. And sort of that reiterates what Brian's talking about. All that being said, 30 days out, and a lot to unpack as far as what ends up happening with the market and the Fed rate cuts. We will be back in front of you in just over 30 days on the eve of that election with our October monthly update. So thank you so much for watching.